Moving averages. You are going to love this. Moving averages are fantastic. I use them on a daily basis. They're used by rookie traders right to the top, professional traders and analysts. They show you so much. They are so useful. They are fantastic. I love them. Moving averages. You're going to love them. If you're new to moving averages, this video is going to be a real eye-opener. You're going to see how useful they are when it comes to analysing the markets. Okay, moving averages. What are they? How do we use them? Moving averages are, as the name suggests, they're averages that move. If you think of a price chart and you have a moving average of 50, so the setting of a moving average can change. You can have a moving average of 25, of 1,000, of 73, whatever. But if you have a moving average of 50, it will take the closing price of the last 50 candles and average that. When the next candle closes, it will take 50 candles from the most recent candle back, work out the average, plot that on the chart. Next candle closes, it takes that candle plus 49 back, so 50 candles in total, puts the average down, joins all these averages together with a line, a bit like you see on the slide here, to create like this line across the chart. It shows the average of price over time. It's a moving average. You really don't need to know the formula or how these indicators such as moving averages are created. You don't need to know everything about it. I thought I'd just mention a bit how it's calculated, but that's not important. What's really important is how do we use this in trading. There are indicators I use that I don't know, the formula. I don't know how it's calculating, how it's taking price and displaying information, because it's not important. What is important is how do I use this indicator, how do I use the information it's showing me to make money, to make profitable trades, to analyze future price direction. So how are moving averages used? That's what this video is going to be all about. We're going to look at how moving averages are used in Forex trading. There are three main ways. The most three common popular ways moving averages are used are for current price direction. So current price direction, price reversals, so when direction could be changing, and support and resistance. And I'll be going through those three things in this video. There's one more slide here and then we'll look at some charts. So this is what a moving average looks like. It's this purple wavy line across my chart here. So I still have my Japanese candlesticks. The chart looks very similar to all previous charts in this series, but we have this line coming across the chart here. This is the moving average. So there's three things to mention before we start looking at the charts in detail. Number one is periods. So moving average period. That is the setting of the moving average. As mentioned, you can have a moving average of 100 that takes the most recent 100 candles, the closing price of those candles, plots the average. Or you could have a moving average of 5 that just takes the last closing price of 5 candles and plots that on the chart. So moving averages have different periods. Anything you want from 1 to infinite. Okay? The most commonly used periods though are the 7, the 14, the 21, the 25, 50, 100 and 200. So 7, 14, 21, 25, 50, 100, 200. If you ever watch Bloomberg, if you ever watch professional analysts looking at charts, they generally use the 100 and 200 moving averages, but there are those others that I mentioned. There are different moving average types. There's loads of them. The most popular are the SMA, which is a simple moving average, and the EMA, which is an exponential moving average. Once again, you don't really need to know what these different types do. The moving averages I'll be using in this video are SMAs, and I use SMAs. They're just simple moving averages. That's what I use on a daily basis. There are loads of different types. You can have a look at that in your own time. It's not really important. at the moment to learn the basics of moving averages. The color is not important. I have a purple moving average on this chart in front of me. In future slides it could be green, red, blue, indigo, whatever. The color isn't really important. So you can change the color of these moving averages just like you can with a lot of indicators, but that is not important. Okay, so let's get started, and we're going to get started with price direction. So moving averages can show price direction. So looking at this slide in front of me, this is a chart. This is US dollar, Japanese yen. It's the 4-hour time frame, and this purple line coming across the chart here is my moving average. Okay, now there's a couple ways we can use this moving average for price direction to know the current price direction. Number one is price above the moving average or is it below the moving average? If price is above, if the candles are above the moving average, that generally means that momentum is bullish, that direction is bullish, it's going up. Whereas if the candles are below, if price is below the moving average, that can signal that price is bearish, that the momentum is bearish. Another way to use these moving averages for price is which direction is the moving average heading. If the moving average is heading up, that can signal that price is uptrending, that it's bullish. If the moving average is moving down, that can signal that the market is bearish, that price is downtrending. So we have an upward moving average here, price is above the moving average, and price is moving up. It's bullish. We have an uptrend. We have swing highs that are higher and swing lows that are higher. So just to recap, the direction the moving average is heading can signal the market direction. If price is above the moving average, that can mean price is bullish. If price is below the moving average, that can signal price is bearish. Now there is a warning here. A lot of indicators only really work for trending markets, and you'll see in later slides in this video that if a market isn't trending, then moving averages as well as other indicators can give off false signals. They don't really work, and I'll demonstrate that in this video. So here we go. We have a moving average that's down, so it's coming down, and we have candles below the moving average. Price is below the moving average, and price is downtrending. It's signaling, it's helping you know the direction of the market. Okay, all these indicators are here to help us in our analysis, to make things more simple, to make things more clear. We can look at our moving average and say we know price is downtrending without even looking at the swings that price has formed. I don't suggest you ignore the swings, still use them, still look at the Japanese candlesticks. This is just a guide. The moving average is just a guide. Okay, so what has happened here? So we've had a moving average come down, move sideways, and move up. What has price done? It's been downtrending, and then it started uptrending. So we've had a downtrend here and an uptrend. If we were to look at the swings, we have our lower highs coming down like this. So lower highs, a break, a higher high. There's actually a double bottom pattern here. If you watched my pattern video before, there's actually a triple bottom here. 1, 2, 3. But that'll be covered in a future video. So this moving average was coming down and it's moved up. Price was downtrending. It's now uptrending. Price was below the moving average, so price was downtrending. It then moved above the moving average and price started uptrending. So these moving averages don't just show market direction, they can signal and help you identify when direction is changing. So we've had a downtrend become an uptrend. Price has been below the moving average, has moved above it. That can signal the start of an uptrend. The moving average was moving down, it's now moving up. That can signal price was downtrending, it now could be uptrending. Okay, so we have market direction, uptrends and a downtrend, so uptrend here, downtrend here. We also have a change of market direction. And we have the same thing here. So look at price, look at the candlesticks, look at the moving average, what's happened here. Price was uptrending, it's now downtrending. And how has the moving average helped with that? Well, price was above the moving average and then moved below the moving average. So we have an uptrend here, which then became a downtrend. Now these moving averages, as well as many indicators, if not all indicators, are referred to as lagging indicators. It means that they use historic price data, so it's not in real time. These moving averages will signal, or generally signal, changes of market direction or signal other things after it's actually happened. So when price moved below this moving average, we already had the start of a downtrend. So here was the uptrend here. So the downtrend had already really started by the time we got the moving average above price. So it's a bit lagging. Doesn't signal the top of the move, the tip of the price direction. Okay, price is not trending here. Price is moving sideways, and we have all sorts of signals from this moving average. We're below the moving average, we're above the moving average, we're below, we're above, we're below, we're above. Lots of false signals. As mentioned earlier, moving averages only really work in trending markets to signal price direction, but I may contradict that in a moment. So the principle of price above the moving average or below the moving average shows price direction is not really applicable when price is ranging, as you can see in this slide. But moving averages can signal ranges, can signal indecision, market indecision, sideways markets, because the moving average itself moves sideways. So if the moving average is moving sideways, that is an indication that the market could be moving sideways. So just keep an eye on that. Now things are going to get really interesting now. I have two moving averages on this chart, a green and a red. I think it's the 25 and the 50. Using the same principles before, price is above the moving averages, they're moving up, we have an uptrend. That is still applicable, but you can see with my two moving averages, we actually have something called a moving average cross, which is here. So the moving averages cross. Now when my green moves above my red, okay, so when the smaller setting moves above the bigger setting, so a 25 and a 50 moving average, that can signal the start of an uptrend. Or another way to put that is the end of a downtrend and the start of an uptrend. And you can see in this case that we have the moving average cross and then price uptrends. Let's look at some more examples. This will become more clear as we look at things. So we don't have a crossover in this slide, but we have the red above the green. Okay, so we have the red above the green this time. So an uptrend, we have a green above the red, the 25 above the 50, or the faster or smaller moving average above the slower moving average, the bigger setting. When things are in reverse, we have a downtrend here. So now the slower, bigger moving average is above the smaller, faster. The 50 is above the 25, the red is above the green, and we have a downtrend here. Okay. Same thing here. Uptrend, green above the red. Here we have a moving average crossover again. So we have the green above the red, and price is uptrending. With the crossover, the red is then above the green. It signals the end of the uptrend and the start of a downtrend. So these moving average crossovers can signal change of market direction. We do the same thing here. So we have a crossover here, price downtrends. We then have a crossover here. So this could signal the end of this downtrend and possibly the start of an uptrend. So quickly, let's recap. We have moving averages show price direction, if price is above or below moving averages, and also the direction of the moving averages, but they don't work in ranges. Then we have two moving averages. When one is above the other, the faster above the slower, or green above the red, that's the settings I use, the colors I use, it signals a potential uptrend. When the red is above the green, a downtrend. The 50 above 25. When these moving averages cross over, it can signal a change in market direction, as it does in this slide and in this slide. Lots of crossovers here and no trends. Once again, these moving average crossovers don't work if price is ranging. They are for trending markets. I'm trying to keep an eye on my trades that are open. It's quite busy at the moment, there's lots going on. We have another moving average crossover here, so we have a downtrend, the moving averages cross, we have an uptrend. If you're trying to trade the moving average crossovers here though, it just wouldn't have worked. These keep crossing and price isn't downtrending or uptrending. So once again, it's only really suitable for trending markets. Okay, price direction, price reversal. The last way these moving averages are used is support and resistance, and it's actually called dynamic support and resistance. If you've watched this series to here, you'll know that I've covered horizontal support and resistance, diagonal support and resistance. This is dynamic support and resistance that's formed by the moving averages. So those commonly used moving average settings that I told you about, you know, the 7, 14, 21, 25, 50, 100, 200, they can provide support and resistance to the markets. Every time price reaches one of those moving averages, price can reverse at that moving average. It provides support. It also provides resistance. So in this example, price is reversing, it's finding support at this moving average. And in this slide, resistance. So price keeps reversing. It's bullish and then becomes bearish off the moving average. So these moving averages can provide support and resistance. And if we have a look at this chart, you can see support, resistance, support, a number of times, resistance, resistance, support. So when the moving average breaks, when it's not acting as support resistance, it can then reverse. Floors become ceilings, ceilings become floors. Just like horizontal support and resistance and diagonal support and resistance. We have another example here. So resistance, nothing really here. So resistance becomes support, 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 support. So these moving averages really work. Once again, if price is ranging, these moving averages provide very little support and resistance, as demonstrated in this slide. We've come to the end. Moving averages. Please practice what you are learning. Please ask me your questions below. I hope this video was helpful. I'll speak to you again.